thanks for a very informative presentation. And what I want to do is, I guess, sort of move on to a very specific area of tax risk and technology and compliance. Just by way of introduction, so I'm Tony Katsigarakis. I'm the Commercial Director in the Corporate Reporting Solutions Group at Wolters Kluwer, more commonly known as CCH. We're changing our name at the moment. So, we haven't got the slides here. Perfect. All right, perfect. Okay, so what I'm going to be talking about is compliance risk specifically, and focusing on one particular element of technology. So today we sort of talked about how do you manage your tax function and how do you manage risk. And what I want to sort of take you through is, I guess, a picture of where we used to be 20 years ago to where we are today. And whilst a lot of things have changed, some things haven't changed. The reason I'm focusing in on compliance specifically is because ultimately, when you look at everything that we do, it all comes down to a handful of numbers, and you want to make sure those numbers are right. That's what compliance is about. So let's have a look at the historical context. Why have I picked 1995? The reason I picked 1995 is not just because 20 years is a good time frame to work on. The mid-90s is probably around the time when spreadsheets was coming into its own. It was a very commonly, widely used tool in all areas of finance and tax. And what I want to do is just look at how the world's changed from then to now and how some things haven't changed. So let's have a look at just reporting and compliance and complexity. So let's look at the mid-90s. If you looked at the tax manager from a compliance perspective, the primary deliverable at the end of the year was really the tax return. That's where all the focus was. There was still tax reporting, of course, but it was really an afterthought, and it was the hot potato that was flicked between tax and finance. Let's roll forward to 2015. Now the tax return is actually the afterthought. The core focus is now tax reporting. Most of our clients are now reporting on a quarterly basis. Many of our clients are reporting on a monthly basis. And then at the end of that process, the tax return rolls out. But even the tax return doesn't sit still now, because with PAYG instalments now you're required to do that monthly. So that's changed a fair bit from those days. Let's roll back to 1995 and look at indirect tax. Indirect tax, or GST, wasn't actually out in 1995. When we talked about BAS, it was usually a fishing trip on the weekend. Let's roll forward to 2015, and BAS is actually a monthly process. A lot of your team probably work weekends to try and get your numbers done. And whilst a lot of your systems maybe spit out the numbers that go into your BAS return, there's increasing pressure from the regulator for you to do a lot more analytics over your data to make sure you get that correct. Let's roll back to 1995 and look at country by country. Country by country in 1995 probably was your travel itinerary. Roll forward to 2015, and Australia is the first of the OECD countries that's going to enforce country by country reporting starting 1 July 2016. So that's changed as well. Roll back to 1995, look at the tax function. The tax function was the poor cousin of finance. It was a back office function, rarely heard of, and not really that visible to the rest of the organisation. Roll forward to 2015, and tax organisations are on the front page of the AFR almost every second day. Guess what? Today, it's very much front of mind to the executive. It's very much front of mind to your board. It's very much front of mind to your shareholders. What does that mean for the tax manager? It means more reporting, because they want to be comfortable that you're on top of the issues. You've got systems and processes in place to make sure you don't get it wrong. So when we look at your reporting and compliance requirements over that 20-year time frame, the world's actually changed quite dramatically. So let's go down one level and have a look at the resources that were available to you. Go back to 1995. Typically, your tax team would have enough people to be able to do the work that you needed to do. Typically, they were 5 days a week in the office. Local resources, you might have had an office in Sydney, maybe in Melbourne, but fairly sort of closely held. Roll forward to 2015. Being a back office function, there's constant pressure to cut costs. You need to cut the sizes of your team. You need to cut the amount of dollars you're spending for your advisors. And yet, at the same time, whilst your teams have shrunk and you haven't got the dollars to spend, your compliance requirements have gone up. If you look at the teams themselves, your team is typically going to be dispersed. Flexible work arrangements mean much of your team might be located in different parts of the country or maybe working 3 days a week. We talked a little bit earlier about shared service centres, so you might actually have resources in different countries of varying quality and capability. So you need to be able to deal with that. Let's look at the breadth of your responsibility. Back in 1995, sure, there was a lot of organisations that dealt globally, but it was really a subset. You roll forward to 2015 and probably your children are buying things online. Why is that relevant? It just means because we are now truly global. It means that we are operating globally as organisations. We probably are selling globally, so we have responsibilities to manage not only our local compliance requirements, but there's also global responsibilities. Let's dig down further now and have a look at our regulators. So in the mid-90s, most of us are probably dealing just with a tax office. Relative to today, a fairly unsophisticated organisation that had a lot of manual processes as they slowly worked through reams and reams of paper. Let's roll forward to 2015, where we face a regulator that's manned by people from industry who have a lot of experience on exactly what can and can't be done. They have tools and technology where they can actually dig through things very, very quickly, and a regulator that's very risk-focused, so when they do focus on you, it's actually, the chances are they're focusing on something fairly specific. Let's roll back a little bit and place that in the global context. There is barely an economy in the world today that's not struggling with budget deficits. Regulators all over the world are increasingly pressured to take their fair share of tax, whatever that might mean. What that means is that our own revenue authorities, as well as the revenue authorities around the world, are really becoming very stringent on making sure you do pay your fair share of tax. What that means for the tax managers, you need to actually manage through that. Many of you probably have many visitations from the tax office and you need to deal through that. So if you stand back from all of that and you look at the position of a tax manager back in 1995 to today, the responsibility and the complexity has grown dramatically, but the tools that you need to use, the resources you have shrunk, and yet you're facing a far more aggressive environment. So when you look at that, you sort of think, well, how do you manage that? Surely the underpinnings have changed. But maybe things haven't quite changed. What you see in front of you is a result of a survey we ran in 2013 and ran it again in 2014. The survey was directed at CFOs, heads of tax and tax managers. We sent out to 14,000 respondents. We had over 1,400 responses back, so it's a fairly good indication. One of the questions that we asked was, please nominate the primary tool that you use for some of your key processes: tax compliance, returns, statutory accounts, indirect tax. The red bar that you see are spreadsheets. So even today, spreadsheets, the one thing that hasn't changed, spreadsheets are still the preeminent tool that's used across all organisations. So you look at that and you think, okay, well, yeah, what do you think of that? How comfortable are you with the tools that you use? So one of the intriguing results that constantly comes back is roughly 80% of respondents in these two surveys and a number of others that we've run will always tell you that we're very highly confident or confident that our systems are compliant and they work and they will produce the right answer. And there's quite a high level of confidence when you sit down and actually engage in a conversation. But when you dig in a little bit further and you say, okay, well, you're using predominantly spreadsheets and you're very confident, how does that actually stack up? Well, actually, that confidence isn't actually shared. When you look at a whole bunch of independent studies, consistently, the error rate attributed to spreadsheets is over 90%. A lot of those findings are actually now embedded in various regulatory enactments. Sarbanes-Oxley is probably the first one which created a big grey clouds over the integrity of spreadsheets. When you actually sit down and talk to clients about spreadsheets, one of the conversations I often have with clients is, tell me why you're so confident, and they'll tell us, okay, we're confident because it's fairly efficient, we run through it. You ask them the question, you say, okay, well, what happens, who's responsible for the spreadsheet? Typically, there's one person. So you say, so what happens when that person leaves? Having been in the tax technology industry for many years, one of the biggest drivers that people actually jump off spreadsheets onto systems is because the key person actually leaves. When we dig down a little bit further, we often actually sit down and say, just show us some of your spreadsheets. And having formulated literally thousands over my career, as they go through, you just look through and you say, wow, number embedded in formula. 200 places where you actually have to input data, and often the same data at different parts of the spreadsheet and different sheets. Very poor design. They're very, very prone to errors. When we go one step further and you actually look at the regulators also recognise the risks that are associated with spreadsheets as well. So when you look even with the tax office, when they're looking at, many of you would have heard the Shared Assurance Initiative of late, one of the primary drivers around that and one of the key risks is integrity of business systems, and at the core of that is often the spreadsheet. So there is recognition by the relevant authorities that there are high risks involved, and yet people actually persist. So we look at that and we say, okay, so the primary tool that you use are spreadsheets. You're very confident that it's going to give you the right answers, but the regulators and all the independent studies and bodies don't actually agree with that. So we refer to that as the confidence gap, because actually there's a big disparity between the two. What's actually quite interesting then, though, when you actually sit down and you have that conversation and you dig into the spreadsheets a little bit and you push through, I guess, that initial sort of bravado, I guess, that our spreadsheets are really good, there's a broad recognition. In fact, I haven't met any tax manager that doesn't recognise the risks associated with spreadsheets. And then you say, okay, well, so if you recognise the risks, why don't you change it? Oh, we're too busy. Well, of course we're too busy, because if you look at that historical context, you look at the workload that you have now compared to 20 years ago, look at the resources that you have and look at the things you need to deal with. You no longer have the time. So we talk about a risk paradox where actually there's a recognition of the risk, but we're too busy to do anything about it. So what do we do? At a very high level, I guess the key thing is, if you're running your business off the back of a spreadsheet, then you probably need to look at that again. It's not that spreadsheets are going to go anywhere. Spreadsheets are going to be a tool that will be around for another 20 years, but it should not be the backbone of your organisation. You should have robust systems that are actually backing that up. Is technology the answer? It's a component of the answer. I'd like to say that it's all the answer, but technology is one piece. When you look at the holistic picture, there's a whole thing that encompasses the people that you have, the right skills, the right positions. It's the processes and the controls that you have. It's data integrity. And then there's technology. But technology is a key piece. In today's world, technology is a critical piece of actually achieving a good outcome. One of the first objections that you have whenever you put a system in place is, but we're really happy with the way we do things. I guess my initial response to that is, if the way you're doing things is backed on spreadsheets, you probably should revisit that in the face of all that independent evidence and requirements that come through. But even if you do have a system in place, it's also worth revisiting every couple of years. If I stood in front of you today and talked to you about, I guess, our main platform, which is Integrator, 2 or 3 years ago would have been about compliance and provisioning, Australia, New Zealand, some limited application. Today, and we talked a little bit about that a little bit earlier, if I talk about that same platform today, I can come to you with a single platform where you can manage all your global provisioning, compliance in many jurisdictions, all your indirect tax, all your analytics anywhere in the world, a whole bunch of workflow tools and risk management tools on a single platform. Right, that world has changed. If you haven't seen that world, you need to keep yourself up to date. This same conversation in 2 years' time will be different again. So it keeps on changing. So even if you have robust tools in place, you should revisit that every once in a while. The next one's also a really big objection that always comes up, and it says, well, look, we've looked at a lot of the platforms in place and it doesn't really do things the way we do things. It's actually the wrong question, because they're not designed to do things the way you do things. What they're designed to do is to do things in a better way, be more efficient, minimise your risks. So the right question is what I'm looking at in line with best practice? Is it going to improve the way I do things? Is it going to manage my risk far better than I do today? And at the end of the day, I guess, why all this focus on risk? At the end of the day, risk is very important, because if you look at the board and the executive and you look at your shareholders, the last thing they want to do is to see the name of your organisation on the front page of the AFR. It's also important from a regulator perspective, because when they come and knock on your door, they're not going to search through every document that you have. They're going to assess your risk profile. And based on that, they'll determine the level of activity, which will make the difference between opening an office right next door to your boardroom or whether it's just a quiet coffee a couple of times a year. So it becomes quite important. Now, I'm very conscious of time, so I'm not going to go through this slide in a lot of detail, but when you're evaluating systems, sure, there's all the minutiae of all the things it needs to do, but there are some guiding principles that are actually worth considering that you should actually tick off as you go through. So here's some of the attributes at a high level. As I'm talking, you might want to note down the website at the bottom, where I've actually got a YouTube video that goes into these in a lot more detail as to what they actually mean. But very quickly, whatever you look at, it's got to be fit for purpose. You want to minimise the number of systems. So the fewer systems you have in place, the easier it is to administer. Simple things like somebody leaves. It's easier to remove one person from one system than removing them from 20 systems. The risk of actually missing something over 20 systems is a lot higher. It also gives you the chance to leverage what you're doing. You want to be able to leverage related processes. So very simplistically, your trial balance upload actually feeds into your tax reporting, which feeds into your stat accounts, which feeds into your tax return, which feeds into the reporting to the regulator as well as to your executive and board. Look for a system that can actually do that whole lot or is moving towards that direction. The more you can leverage the process, the more you can actually do a calculation once and then reuse that, the lower the risk, the higher the efficiency. The more times you replicate a calculation, the higher the chance that you're going to get it wrong. You want to maximise automation. In a perfect world, it'd be great if you never had to touch any data at all, but of course that's unrealistic. But utopia really is to only ever be able to touch a piece of data once. Once it's in the system, it should just permeate through the system. You shouldn't have to manually adjust that in any other way. We talked about minimising your reliance on spreadsheets. You should look for systems that provide you with risk management tools. Audit trails. Audit trails will show you source data to disclosure, to be able to trace back the disclosure back to source. The ability to be able to track and record the reasons you made certain decisions. The ability to actually go in and see who logged in, when, and what changes they made. The audit trails are quite important because remember, where this becomes critical is not today when you finish your numbers, it's in 2 years' time when somebody knocks on your door and wants to know how you arrived at those numbers. You look for tools with workflow, checklists, and other capabilities. You want to use tools and maybe keep all your data in one place so you can run some data analytics. Data analytics gives you a higher chance of spotting problems and better understanding your business so you can do things better. Sorry, I'm rushing through this fairly quickly. Configuration versus customization. Customization always sounds really good. Somebody comes in and builds you exactly what you want. Sounds really sweet. Until year 2, you get the bill because you realise that you've got to customise every year. So you begrudgingly pay the bill. Come to year 3, you don't maintain it anymore. It's too expensive. You fall out of date, you're right back to where you started. In a perfect world, look for a system which allows you to configure it so you're actually just part of the normal upgrade process and you can actually maintain it in accordance with your needs. Cloud versus deploying internally. Most organisations now, across our clients, over 80% actually host with us and go for the cloud option rather than internally. There's a whole bunch of reasons around it, but fundamentally, as a user, there's a big difference between somebody sending you a CD and saying, give it to your IT people, waiting for IT to prioritise it, work it out, realise 3 months later that they're not familiar with the platform, come back with questions, and 6 months later, eventually you have your upgrade, as distinct from getting a phone call on a Wednesday saying we're upgrading on Saturday night, and you come in on Monday morning and it's all done, because it's done by people that know the system and deployed properly. So whilst I know the profile of a lot of organisations still vary, we still encourage people towards cloud, and I think ultimately this conversation in 5 years' time, everybody will be on cloud. And then finally, in-house versus vendor development. It's always a very fine line, but really it's a question of scale and expertise. These systems aren't simple to maintain and develop, so if you're bringing it in-house, you want to make sure that you've got the scale and the expertise, not only to build, but to also maintain, because it's not a 1-year journey, it's a 10, 15-year journey as well. So as I said, I've gone through that really, really quickly. The more detail around that is on that cchintegrated.com.au website. And thank you very much for your attention and your patience and not running out the door last thing on Friday afternoon. Free to go home. Enjoy. Thank you.